Hey everybody, just trying to make sure everything's set up right here and working. We're going to get started in just a moment. Hope everybody's having a great day today. It's coming up on Valentines this weekend. And different year, different kind of environment we have this year for Valentines than normal. I know we've got a lot of folks loading on the call still, so I'm going to just kind of sit tight for a minute before we get started. Hope everybody has some nice Valentine's plans for the weekend. Guys, if you're on the call, don't forget, you can do something here. Got to go get something. A doghouse is not a fun place to be. So don't forget, you got 48 hours. That's probably why we put this on today, to help you remember it's coming up. None of us want to be in the doghouse, right? So it's interesting, the history of why Valentine's, been doing this work as a financial advisor for folks for a while. And I've always tried to get with some of the folks that were with me in the very beginning to do something on Valentine's. And it was kind of just for fun. But over the years, I started maybe trying to invite some people to different things. And I always want to do something on Valentine's, just to remind you, go out there, find the person you love, and take time and let them know how much you care about them. I'm going to go through a little update today about where we're at in the markets. This is more generic than it is actually about implementation of strategy. But I think that we're in an environment where the world is really different right now. It's really off tilt from what normal has been. And our presentation title is Hindsight, Not So 2020. Last year about this time, we did a presentation talking about 2020 vision, and boy, we had no idea. So, but what I want to do with this presentation is talk to you about essentially how the world is working with the financial system and kind of what it means for us, and help to clarify some things that I feel like are keeping folks from making the best decisions, because the perspective that we have when we look at the world today is changed from what many of us have grown accustomed to over the years. So as I start here, just want to make sure everybody knows there's nothing in this presentation that needs to be considered financial advice. This is for educational purposes only. There's no recommendations to buy or sell anything here. This is really just to help everybody get a great perspective. Myself and our team, we're all registered reps offering securities and investment advisory services through Cetera. And of course, you can read the rest of the disclosure note there. So, I think if we were all to flash back 12 months ago, we would have never in our wildest imagination thought that we would have a year that we've had. The introduction of coronavirus has really been something that we will all remember for the rest of our lives. Clearly, hindsight was not 2020. But I do want to talk about some things that I feel like we do know now, and that shape maybe how we should be thinking about our decisions with financial planning and even our investment mindset, right? Because things have changed so much. And I want to kind of talk about this from the notion of what I would call the hazmat recovery. The government and the different institutions of government have implemented so much stuff in the last year that have influenced what's going on. And a lot of people don't pay as much attention as others and aren't really aware of the significance of it and how it should play a role into our thinking when we're thinking about investing in our financial plans. But I want to walk you through some things here that I think just frame it out, okay? So first of all, before we get into what has happened on the government side, I want to just back up a second and talk about pure demographics. Many of you are old enough to know that from 1980 to the year 2000, the stock market and the economic condition of our culture grew at an unprecedented rate and just brought incredible returns for 2 decades. And what was happening in those 2 decades in the background is that the baby boom generation was really in either reaching or during or kind of the tail end of what we would consider peak spending. And there were more baby boomers at that time coming into peak spending and consuming and building families and all that than there were Gen X generation to follow. You can see that the Gen X generation is not as many people. And then, when we kind of think forward, the number of millennials that are coming behind the Gen X. I'm a Gen Xer. I'm going to be 50 in a few weeks, which is absolutely insane. But for those of you my age know that there's a whole lot more people older than us, and there's a whole lot more people younger than us that are, if you're in the 50-year-old band. But the key thing here to understand is that household formation, people getting up, going to work every day, trying to earn a living, put food on their table for their families, building bigger families, having kids, those things drive the economy in a macro level. And we are now at a point where the millennial generation, which is bigger than the baby boomer generation by a substantial number of people, are going to be in this peak earning period of their life, probably for the next 10 to 15 years. So that's a driver for our economy that a lot of people take their mind off of when we're thinking about COVID and the political woes and so on and so forth of today. But that's still out there and it's still real, okay? Here's some things we know for sure. Well, we believe we know for sure based on what the news media tell us. To date, we haven't heard of anybody that's had a vaccine for COVID dying of COVID. So if the assumption is the vaccine is working, then we know it's just a matter of time, maybe months, maybe a year, but it's just a matter of time before everybody who wants it can get it. And the impact of COVID, the grip that it's had on our culture and on our business world and the way we do business will loosen. We'll be able to get back to things that don't require such difficult things to happen once we have a large scale vaccination. We know this. So we know this is coming. It's a matter of time. So that's a known. I think it's good for the economy. We also know that this response to COVID from all of the governments around the world is very historic. This is a chart just showing us historically all of the different moments in time where governments decided around the world to dig into their coffers, to go out and borrow money or to print money, manufacture money, and dump it into the economy. And I want everybody here to understand, begin to grasp the magnitude of what has occurred here with the financial system. So on the left-hand side of this chart, you can see the global financial crisis where Europe, Japan, UK, the US all went in and spent money, made money, created money, pumped it into the system to help us get out of that really terrible recession that many people call the Great Recession. And we spent 8-9% of our economy in debt those years to get out of that problem. There was the Great Depression, which was a similar amount of required government intervention. The Second World War was a big event from a standpoint of governments going out, but all of the red dots here represent the debt or the borrowed money or the response financially of the governments to deal with keeping the economics moving. In the US, I think is even more important than the UK, Japan, and Europe because our economy represents such a big part of the world economy. But essentially, as of December, we have put into play, into the markets, about 16% of 1 year's GDP. And of course, then we haven't yet done it, but it's already been approved. We know another approximately $2 trillion is coming from the new spending bill. So very historic amount of capital being funneled into the markets that go into the price of financial assets. This is not a small thing. This is the most historic government response of financial capital of all time in terms of this COVID situation, right? So we know that money is out there. We know that, and we call it the stimulus bomb. It's such a massive amount of money, right? We know that it is working. We can see evidence in a lot of different places. For example, this is a chart of unemployment just for the last, well, it goes back to 1970, but you can see that last spring unemployment spiked up to almost 15% unemployed in the US. But the dramatic impact of all the money going to work really pushed that number back down in a hurry. And we're almost back to the 50-year average unemployment rate. So there's still some folks that haven't got fully back to work or maybe who are underemployed, but we're getting close to the 50-year average unemployment rate. And, for many years, like 2012, 14, so we operated well below the long-term unemployment rate, really working at full capacity in the economy. But we know the stimulus bomb is working because unemployment has really dramatically been reduced. When you look at the different sectors, so again, just giving you more pictures, more pieces of the picture here. These are all economic indicators, and you can see on the chart in the column in the middle that different sectors were impacted more with more difficulty than others with the peak to decline. So for example, the leisure and hospitality sector from the end of 2019 to the really worst part of the unemployment, maybe early summer, was down almost 50%, was down 49%. That's a big drop off in that sector. Consumer spending was down 18%. Housing starts for last summer were down like 41%. But if we look at today, or really as of the end of December, you can see that a lot of those sectors have actually really recovered a lot. They're still down from the highs of December 19 prior to COVID, but they're down 6%, 5%, 2%. And there are a few sectors in our economy that actually are fully recovered and actually producing more now than they were prior to COVID, which would be retail sales, capital goods shipments, and rail traffic. So you can see on the right that much of our economy has fully recovered. There's a few isolated sectors that haven't. This chart actually shows us really interestingly from an earnings perspective in corporate America, the S&P 500, that energy and airlines and other travel related sectors, they are responsible for about 40 billion. I think it's 40. Well, it's 40,000, but so maybe 40. Yeah, 40 billion. I think that's right. That they are responsible for more of the net losses than everybody else. So you have a situation where those three sectors are really the only three things that haven't recovered on an earnings front. And we think that the vaccine is going to help to get those sectors back online here in the next few months, or worst case, maybe a year out. Because again, once everybody's vaccinated, we don't have any reason to believe that these sectors won't get back to where they are at. So the point of this is that corporate resilience is really high. Like corporate America has really pulled through this thing, and for the most part is getting near to be back where they were before. When you look at just trend GDP, just our gross domestic product in the US, as of the end of Q4, actually the end of Q3, we didn't have the year-end data, has not been finalized. You could see that most of the loss in GDP had been recovered, and soon we expect to be back to where we were prior to COVID. Not that we'll be back on the same trend line for growth going forward in the very near future, but certainly in the next couple of years, it's very conceivable that we'll be right back where we would have been had there been no COVID from an economics perspective. So these are really positive indicators on the business, earnings, corporate America front. If you look at consumer finances, it tells you also a sort of a different lens. The average household net worth today at the end of the fourth quarter, all-time high. So those dollars that have been pumped into the system have funneled their way into businesses and spending, and the spending's funneled their way into asset price appreciation. And so the consumer's balance sheet looks good. The amount of assets relative to the total amount of outstanding liabilities on average is very healthy. The amount of debt that people spend every month is a pretty low number relative to historical standards. And so I put here appear to be healthy. Now, one thing I want to say here that I think is a growing concern is that the averages don't show you the dispersion of the wealth. And there's a real phenomenon happening because of the way that this monetary process has happened, where people who have homes and real estate, people who have assets and things that can appreciate with the value of all this money getting into the system, those people are getting more and more financially healthy. But the folks that don't have those assets and don't have 401k plans and retirement plans with those things in them, they're not feeling the same benefit because they're not getting the appreciation. And a large segment of our culture and our population don't have those things. So I think that this time that we're in, sadly, in my mind, is creating a larger and larger division between the wealthy and the poor. And I think it's going to be problematic if we're not careful in the coming years, because, it's that distribution is very, very radically different now than it has been in the last couple of decades. A note, even on bond prices, people don't necessarily buy bonds to make money. I mean, they typically buy bonds as a safe haven for stocks or for some guaranteed fixed income kind of stuff or some return of principal. But bond prices have gone up so much that if you buy a bond today, you're going to get negative yields in a lot of situations. The chart on the left shows that the yield on bonds around the world relative to history shows us that we're into negative territory. And really the only other times we've seen this phenomenon has been in war times. The chart on the right shows that, if you just take the actual price that you pay for a bond today, and you have to pay a premium in most cases, and then you collect the coupon and then it matures and you get the face value back, that the premium tends to be today greater than the sum of the interest payments plus the face value, meaning it's a negative nominal yield. And that's happening today with about 35 to 38% of all bonds. And then if you factor inflation into that, like what is the purchasing power of that ultimate maturity, it actually shows us about 70% of all bonds really are producing negative after inflation results. So the bond market is very, very pricey, and certainly alarms us. So we're trying to limit our exposure to too much of the bond side of things. So when you look at all of these things, from a person that would like to see the stock market do well, all of these things would make us believe that we're going to have some good times in front of us. I mean, the economy is getting back to healthy. The demographics are strong. Earnings are getting stronger. The people who have historically loved to buy bonds maybe decide, there's not much there for me to buy. Maybe I'll use some stocks instead of bonds. There's all these things that make us think we could have a really good period of time in front of us for the stock market. So with all of that, what could go wrong? And this is kind of our view, is that there's three things that we just have to be conscious with. And this doesn't matter if you're working with us or if you're working and you're looking at your retirement plan at your office, or maybe you've got another advisor. I think we all face these three core areas of concern. The first one is we got a huge deficit because of COVID and all the money that was either borrowed or printed. We've got to at some point deal with that, or it's going to have a multi-generational effect. And of course, we have to pay back the money that was borrowed. So that'll be a drag on the future economy. But we know that most of that's going to come back from taxes. It's just, there's really no logical way that we can get that money back from growing out of it without increasing taxes. And when you increase taxes, particularly on businesses, the investors who are buying those businesses to get their portion of after-tax income, well, if you got to pay more taxes, you're going to get less income. So there's a direct correlation with rising taxes and the value that someone would be willing to pay for a stock. So if you're in a high income tax bracket, or if you own companies, we think that this process of taxes going up will be a drag on your ability to grow your net worth. It's not that it'll, destroy us all or anything like that, but it's going to be probably more taxes next year and the year after than the years in the past. Knowing that, we have to pay more attention than we've had to pay to tax management over the last decade, because taxes are going to matter more. So that's an area we have to be concerned about. The second is the notion of inflating our way out of this problem. Now, back in the fall, the Federal Reserve told everybody publicly that they're going to let the Fed's target for inflation float up to substantially higher than it has been for the last 20 years. That's telling us that they're going to continue to do things that make the value of the dollar go down relative to the goods and services that you can buy with the dollar. For people who have assets that those dollars land in and those prices go up, it's not a bad thing necessarily, because the value of the assets would go up if there's more and more dollars being diluted. The problem becomes is the people that don't have assets that appreciate. And it's a large segment of our culture does not own risk assets or assets that can grow. And so I think that the inequality things that we see in our culture today are going to get even worse if we don't put more of the getting the deficit dealt with taxes and less by inflation. Both of these mechanisms will help bring things back into check over time, and we'll get there. We'll get back to a more normal financial system. But depending on whether it's taxes versus if it's inflated the way there, will have an impact on how our population exists and feels that socioeconomic impact, by sort of different groups of people. So we need to be conscious there. If that gap gets too wide, it could be problematic. And then the last piece I think is really a concern, and I've talked to a lot of my clients here in the last 6 months or so, is that valuations for stocks are high. Okay, high meaning that the price we pay for a stock today, like the top 20 brands in the S&P 500, they're selling anywhere from 35 times earnings to 80 times earnings. And historically, S&P 500 companies tend to sell between 13 and 20 times earnings. So we're seeing these really high price tags on stocks. And I'm a little bit concerned because a value-based person, someone who goes to the grocery store and says, I'm only going to buy it when it's on sale for this low price, that mindset might hurt people here if you don't understand what is the reason that someone could substantiate these high price tags for stocks. And so I made this little analysis and I'm going to go through it in just a second to help everybody kind of understand why stock prices maybe should be priced in those ranges. And I'll talk to you about that in a moment. But before I do that, I want to explain one other thing. A lot of the stocks that are out there, especially the smaller companies, the mid-sized companies, the value type companies, they're not overpriced. In fact, they're actually under their long-term averages in certain situations. And so as the market gets past this coronavirus period of time, and the businesses that have been hurt the worst from the coronavirus get to kind of resume normal business, I think you'll see this rotation, because it'll be a more opportunistic investment for an investor to take money out of a really high priced, say, tech stock and go and purchase a small cap stock that is now getting back online and now their business is really growing again. So we think there'll be this sector rotation where money will move from the nosebleed price stocks to some of the cheaper stocks. And if that occurs, folks that are just using passive indexes, you might not get any gain from that. You might lose on this side and it'll gain on this side. And if you put the two together, you might watch your statement kind of just pretty much be sideways. And so in order to participate in being a part of trying to capture some opportunity in rotation, you have to use some things to look to specifically try to be opportunistic. You got to use active management. But let's talk a little bit about this putting it together, and I'm going to come back to this price tag thing in a moment. So I think investors, when you think about all these positive things that the market has to say it's stable and looking forward could be good, that's our sort of long-term focus. But because prices are so high, the volatility that we could experience in the short run with, any sort of surprise setbacks, whether there's a supply disruption of the vaccine, whether there's another type of natural disaster, if there's some type of wartime issue, it's the unknown things that cause people to lose their confidence and then creates volatility. When prices are really high and you go into volatility, the losses in the short term are really more dramatic. So we need to really manage our minds and prepare ourselves for larger short-term ups and downs. Okay. So that's one thing. I think the other sort of take that a step further and to say, rather than put all of your money in things to try to grow, like if you have money that you're going to need for something in the next 6 months or the next year, or maybe you got to pay tuition for your child at college next year, I don't believe it's prudent to put that short-term money in the market or in any risk assets, because the volatility could really be substantial in the short term. So you don't hurt yourself if you undergo a period of volatility unless you're forced to sell something while it's down. So I would say long-term view is very, very good. The midterm view is probably good, but the short-term view is completely clouded. because we could have any surprise at any moment to make the market move up and down in the short term. All right, so that's a piece that's important. And then I want to wrap up with this perspective. It is so mind-boggling to understand the impact of how much money has been invested and put into our financial system. We know $7 trillion of total stimulus in 2020 from the US alone went into various places of our economy. Everything from the CARES Act to the PPP program, to all the unemployment checks that went out, to the Federal Reserve digitally creating over $2 trillion to stabilize the bond market back in March last year. And now we've got another bill that just passed for an additional 1.9 trillion. So this is an enormous amount of money. And it's so mind-boggling to say, well, how does that impact things? And I just came up with a really good way to illustrate what those numbers mean, all right? But we know big picture, they will drive prices of things up because you're pouring that money into an economy that has a fixed amount of goods and services. So the more money you pour into it, ultimately the price of each goods and service has to go up because there's just more money chasing it. But imagine this for just a second. This is really just conceptual, and I think it'll really help everybody. If you took dollars and let's convert them into seconds, or let's say units. So 9 million seconds is 104 days. So just think for a moment, if 9 million seconds is 104 days, that gives us a perspective that we can start from, and say 900 million seconds is 28 years. Big difference between 9 million and 900 million, right? 9 billion would be 285 years. And this is what I want to key in right here. 900 billion seconds. Think about this for a moment. 2,853 decades. Now I want to talk about 900 billion for a moment. In 2008, we were in the crisis mode from the housing crisis, the financial system crisis, as a worldwide market sell-off that was right there at the same level of sell-off that we saw in the Great Depression. The government in the US enacted law and put about $880 billion into the economy at that moment of time. That stimulus turned our economy from going down quickly to not just stabilizing, but literally propelled it in 2009, 2010. It actually was so much injected money into the system that people that invested in early 2009 and 2010 made a lot of money, right? Now, 900 billion was what we did to solve that crisis. Think for a moment, what does 9 trillion look like in seconds? 9 trillion is 2,853 centuries compared to 2,853 decades. It's 10 times the amount of quantity. So the mindset that hopefully someone that can just digest this and conceptually understand what I'm trying to say is that when we talk about billions and millions of billions and trillions, it's all super large, crazy numbers. But ultimately, what I think is the point here, we've created 10 times more stimulus than the greatest amount of stimulus ever created in history, just 2008, 13 years ago. And we know 13 years ago that created enough momentum in the financial system to make everybody have some pretty positive returns and good fruit from that for 3 or 4 years. This is 10 times the amount of stimulus. And so when you take that quantity of stimulus and you add it on top of the fact that, earnings are improving, unemployment's almost back to normal, there's a vaccine at work and it's getting out there, the demographics by themselves are going to be the best demographics for growth that our country's ever seen. You take those pieces and you have to start thinking, well, maybe that's why people are paying 40 and 50 and 60 times earnings for some of these really high growth companies, because the money's got to go somewhere. It has to land somewhere. And so I think it's landing in the stock market. And of course, the bond market and the real estate market and the commodities market and every other market too. So to conclude this call, there's no call to action here. This is about just helping people to get some perspective that the valuations that we see and how we process that relative to what we've seen in the last 20 years or longer at a glance don't make any sense. They make no sense at all. Why would somebody pay 40, 50 times earnings for a stock that they could have bought 10 years ago for a third that? But when you factor in all these pieces, especially the stimulus bomb, you begin to realize, okay, maybe there's more here than I see. So we know there's always going to be challenges going forward. The things that we don't know are the things that'll hurt us. And so we always are looking under the next rock, trying to find the next stick of dynamite. But the fact is, history's rewarded long-term investors through all sorts of circumstances. People that have stayed invested for the long run have done very well. We believe that the concept of taking profits from time to time, moving some money that has gone up in a hurry over to dry powder and sitting tight when things have gotten super expensive, looking for some pullbacks to get reinvested is a good strategy. We do that with a lot of what we're doing. But even if you're not doing that, we're at a pivotal moment in time. I think that if you don't understand how much stimulus has been put into this market and where the market really is right now, a lot of people might miss what could be a very good decade in front of us. So I usually try to get some of my folks together this time of year and just share some ideas. I hope that this will help everybody to kind of just have a good understanding that we're okay. You know, I think the problems that we have in our culture have very little to do with the markets and where the markets are positioned to go in the future. I think really what we have to focus our attention on is how we deal with one another, and you know, how is our quality of life, and inequality and the gap there. I mean, we need to realize it's substantial, and those are the things between taxes and inequality and how we treat one another that I think we all can do something about if we really take the time to roll up our sleeves and make it important. So I'll wrap up with saying happy Valentine's Day to all of you. And we really can't wait. We're so excited about when this period of time is in the rearview mirror so we can get back together and do some live stuff. My team is here. We are so thankful to have all of you in our lives that we get to serve. If you have questions, if you have thoughts, whether it's investment related or even you're trying to figure out, should you buy versus lease, or should you sell this piece of land? I mean, anything you've got that you're trying to decide what's the smart way to deal with it, we're here to help you get some answers. With that, I'm going to wrap it up. Thank you all for coming out, and I'm going to read these required disclosures. Have a great day. These are the views of Adams Financial Partners and should not be construed as investment advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. All economic performance information is historical and not indicative of future results. Please consult your financial advisor for more information. The S&P 500 is an unmanaged index representing the largest 500 companies in the U.S. The Barclays Aggregate Index is an unmanaged index representing the overall broad bond market. Investors cannot invest directly in indexes. The performance of any index is not indicative of the performance of the investment underneath and does not take into account the effects of inflation, fees, and expenses associated with investing. Past performance, it does not guarantee future results. All investing involves risk, including the loss of principal. There's no assurance that any investment strategy will be successful. Thank you and have a great day.